Well, hello everyone. This is Ken Winans and Stephanie Larson from Winans Investments, and I'm back for my quarterly trip to the Bay Area, and we just wanted to put out a quick video and say hi to everybody. As you all certainly, hopefully, you had received either in the mail or on the Tamarack portal, you've all saw your mid-year results, and compared to where we were last April, I think it's safe to say that we navigated some pretty tough waters, and things are looking pretty good. But Steph and I thought it'd be a really good time for us to just talk about stuff and kind of give you our thoughts for the rest of the year. Steph, anything you want to add?
No, no. The market's been interesting, I guess, is a way of saying it. We've been actively rotating, and been really, I think, picky about what we've been in. We still believe in seasonality, although it's not exactly held true so far. I mean, this year, it's not been a big pullback. The whole sell in May and go away. But we're being cautious with it. But all of our indicators are still relatively positive.
Yeah, I would encourage everybody, if you haven't read it, to please go read my last Forbes.com article, which it was titled "The Great Whipsaw of 2025."
That was the commentary too.
Yeah, there you go.
Whipsaw. Yeah.
Yeah. So and Steph's commentary. The point is that this is not. I am not a believer in black swan events in the markets. The problem is people don't study far enough back in history to look for these. But even within this century, I can show you several years where markets were very volatile, and and even if we finished right at this point in time, the market was up, depending on which index you look at, between 4 and 5.5%. So hardly bad. I just think that the volatilities would shock everybody. But a couple of key things. Number one, for any of you who are, and we do have several clients out there who are very ardent about restricting us on ownership of tech stocks. I am not a big fan of that personally. We work for you. That's your call. But a good case in point would be something like an Amazon or an Apple or a Google. Go check and see how those three stocks have done this year. Terrible. They've done absolutely terrible. This is a market where you need to pivot. You need to go into things. And in my article, I literally pointed out that steel stocks are outperforming tech stocks this year. So the point is, there's a shift going on within the leadership within the S&P 500 and the U.S. markets itself. A couple other quick things that I would bring up. Almost all of you have gold and silver ETFs in your portfolio. The metal play is alive and well. I know we get asked by a lot of people about, are we going to take profits? Is this going to blow up? We're very adept at monitoring supply and demand of an equity or an ETF or a metal. And we're still in the buy the dip mode on metals at this point. One other thing I also get asked quite a bit about, there's some of you who have heard from some of our competitors that this is the time to shift into foreign stocks. A couple of things. I've done extensive analysis on foreign ETFs going back to 2000. I will tell you that mathematically, it is true there's sometimes they have a good year, but they are not a buy and hold. They are a trade. And it's my opinion that, especially now with the situation geopolitically, especially with the tariffs, I have a very tough time believing that a country that is commodity driven is going to come out faring well in a trade war with the United States on tariffs. So my point is simply this. You never politicize your portfolio. You should always go where the demand is, where you can make money. But I think doing a wholesale shift into foreign stocks you're going to find it's going to be a fool's errand, to be perfectly blunt.
Well, and we have some exposure. And the thing is, even most U.S. companies have European exposure.
They all do.
They all do. The globalization of the business sectors that's just how things are now. So we do have exposure to it. I wouldn't worry about that. One of the interesting things that we are paying attention is the devaluation of the dollar. It has dropped 10% for the year. So that also is something that we're going to keep monitoring, especially now that we know the big beautiful bill has gone through, and so what that means for financing in the future. There'll probably be a larger than what would have been before Treasury auction, which could also affect yields. The bond space is something that has been very tricky as of late. I think I might have touched on it in the last video that I did. Yields have really dropped. So the spreads have gotten really tight, yields have dropped, pricing is much stronger, so you'll see that reflected in your portfolios. It just means it's a challenging market. I still can get actually some really good yield. I just bought, as for an example, Moore Park, Ohio yesterday. It's paying 7.77. I think, or 6.77. It's still strong, but the market that I can play in is now more narrow. So
And the amount of it you can buy.
exactly.
Yeah.
I'm having to really piecemeal my buys. I actually had to buy 4 different lots of R.R. Donnelley the other day because I just can't find a big seller of it. So even if I like something, I can't always find someone that's willing to sell it to me. So it's gotten more challenging. But the nice thing is we were so aggressive building out the bond portfolios, especially for new money that had come in. So there's not a lot of clients that need a lot of paper. So that's good. We really, hit the nail on the head timing wise. So I'm really glad with what we did. The paper I could buy 2 months ago, I can't find it. So that's great. We were really aggressive with putting the cash to work. So.
And a couple of things to also think about. Steph and I were talking to several people about this. Number one, if we are going to go through some form of reindustrialization in the United States, these companies, many of them that you have bonds in, these are industrial companies. They will turn to the bond market to finance these new factories and warehouses and refineries and all these things they will need. That will all be done through bonds. Same with preferred stocks. Many of these companies will turn to banks to finance this. The banks will therefore issue preferred stock as they did with the railroads back in the 1800s. So the point is, there's going to be some interesting opportunities in the corporate bond, corporate income space as we see going forward. One other thing that I'm very happy to report, knock on wood, Steph and I are both very competitive, and we're both former collegiate athletes. We are once again reaffirmed by Morningstar to be some of the best at the game in the world we play in. So it's good for you all to know that I'll put our record and our medals against anybody. We're pound for pound, we punch above our weight. And I'm very proud of what we do.
We work really hard.
We work very hard, and we take it. And when there's mistakes made, we learn from them.
Yeah.
I would also, I get asked a lot about inflation. Let's just talk about this very quickly. I monitor commodities very, very closely, and I can tell you, as somebody who's hyper studied the 70s and post World War II, you have to have commodities across the board skyrocketing, vaulting in price, in order to have what we would call the kind of inflation situation that's been portrayed as they're calling it tariff inflation. I can tell you as of right now, and by the way, I'll just give you an example. In the 1970s, soybeans went up 1,000%, soybean prices. We have nothing like that going on right now. Now, there are some commodities like cattle, for any of you who've had the painful experience of buying a high yielding or a high end steak lately, very expensive because cattle prices are high. But when you go across the board, whether it's cocoa, coffee, wheat, you'll find that almost all of them are trading in seasonal patterns right now. There's nothing to demonstrate that there's massive disruptions to the supply and demand situation. So when I look at it just from the raw material standpoint, folks, I'm not seeing it. It's just not showing up yet. And the key word's yet. It might down the road, but as of right now, it's not.
Yeah, and I think inflation is around 4.1, 4.2. It's not anything really aggressive right now. It has leveled off, which has been nice. We are watching the Fed. I do expect a cut to come. Hypothetically, there should be 2 this year in the second half, but at least 1. I think Powell was waiting to see a little bit more of the economic numbers, but he's going to have a lot of pressure put on him. And I did touch on this in the quarterly commentary. Most of the developed countries in the world, which I find interesting, have cut. So the only one that hasn't, or that's actually increased, has been Japan. So we are kind of the last to the party on the rate cuts. So I expect probably at the next meeting that we should see a 1/4 point cut. That should be nice. It'll help kind of stimulate the economy a little bit. It should help with businesses as well. As rates continue to go down, it should help in the housing market, which has had a really rough year this year. So we would like to see some improvement. I think that will be it. I don't think he wants to cut too much, because then if inflation picks up, he kind of did the thing. You already did the thing that would really help improve things. You don't want to use all your arrows in your quiver. But I do expect a cut to come. So.
And then on housing, right now, especially if you look at what the big beautiful bill had in it, commercial developers, there's a real emphasis on modernizing and building commercial centers, and with the return to work habits that are all happening across the country. I mean, I see it in Las Vegas. It's actually hard to find office space right now. Housing, I think housing's very regional.
It's very original.
It's very regional. I mean, with the migration of people to Nevada, it depends where, of course. I mean, it's not nirvana, it's not perfect across the board, but you are finding that the migration is alive and well. And a lot of it is about taxes and a lot of it is about financing. It costs a lot to, people were hoping mortgage rates would come down and they're not. One other thing I was going to bring up, Steph started alluding to it, and I think that most of you will just, the Fed is not going to raise interest rates. Okay, that you'd have to have something awfully weird happen for the Fed to have to go into a rate rising mode. So for a lot of you who've been clients here for a long time, you'll remember that when I was buying bonds 15 years ago, the average yield, the average maturity was 5 to 6 years for a portfolio. I mean, we had some bonds that were coming due in 10 years, and we had some bonds, some maybe a little further, and some coming due in 2. The point is, I believe that you all have to get used to the idea where you've been used to seeing your maturities averaging 3 years. You should get used to the concept that the portfolios are going to normalize back to normal, what we would call staggered formation. The whole situation, that the way that we manage bonds is to buy and hold. But just get used to that. As the ladder has to be built out, you should expect the ladder to be extended just a little bit. Okay, so don't panic when you do see Stephanie buying a bond that's coming due in 11 years. I mean, that's just not that far out.
Our longest bond right now is Xerox at 10, and I haven't bought anything right now. I haven't seen a lot of benefit of extending too far. Like if you go to the 8, 10, 12 range, the end of the back end of the yield curve is really flat. So I'm still kind of in the 5 to 7 range, but Ken is absolutely right. I am going to have to extend yields. I think our average right now is actually sub 3. I think it's like 2.7 or 2.8.
Yeah,
so
it's too short.
It's too short. And if you are on the short end, if I look 1 year or 2 year out, you're getting 5% now. I mean, there's just nothing. So you really do have to kind of push out a little bit.
Yeah. Only other thing I get asked quite a bit about, and as you all know, I monitor what happens at state level. So it's just most of our clients are in California. And of course they're spreading all over now. But what I would tell you is that there has been a big push on trying to get people to buy municipal bonds. Again, I would just caution you, please talk to us before you make any decisions on it. I know there's a big push about taxes, but I honestly think if you look at what's being offered and the yields that you're getting on a corporate bond portfolio with Winans, we're still much better off, even if you pay those taxes on that income, than you would be. I mean, to match, if to just take a typical municipal bond, just a general obligation, you'd have to go out 17 years to match us. Folks, that's crazy. I wouldn't do it. It's just not worth it.
Yeah, I would agree.
Okay. What else?
I think I'm going to be in Vegas next week. I'll be there for 3 days. If you want to get together, just let me know. I'll be in the office for a few days.
Sure.
Ken's here this week. I'm there next week. We all
And
get to see each other.
we're going to toy with having a Winans Investment Conference in 2026 in Las Vegas. So best deal for you is you can come on a vacation. Even though I'm not an accountant, but I believe that you can count it as a legitimate business expense to come and see your advisor. So you're welcome to come to Las Vegas, and we'll keep you all posted on that. It'll probably be in the fall next year, certainly not in the middle of summer. So anyway, folks, I hope you're having a good summer. I hope to see all of you again in the near future. Everything here is great. We're all happy and working hard and having a good time.
Yeah, we're gonna continue to protect the portfolios. We've really have been active this year and careful, and we've really tried to protect the gains. We've had some really good years, and so we're just gonna keep chugging along and do our job.
There you go. Chug along.
We'll see you.
Take care, everybody. Bye-bye.
I guess.